Welcome to the Broken Pie Chart Podcast, episode 347, Managing Technical Difficulties and the Like. But we're back now, Mike Snyder and Shane Skinner. Mike, we started, we stopped, but we were talking about volatility. Do you think the VIX is too high based upon the market action, or is it anticipating something that we know or don't know?
Looking at it feels like it's higher than what I've seen the market actually do. With it being this high, you would think that there would have been more of a sell-off than what we've seen. I mean, the market is just slightly off of its all-time highs, yet the VIX broke out of its range. We hadn't seen the VIX jump above 17 really since, briefly in early September. Before that, it was early October. It's sort of just been in this, 15 to 17 range. With a move like this, I would have thought if you showed me this chart that the market would be down more than it is.
We have also seen a spike in the VVIX, which for people who don't know what that is, it's sort of the volatility of volatility. It's the VIX of the VIX. And that, I think it was close to 140 one of the days. And that shows that not only is the VIX higher, but also the premium that people are paying on VIX options is also higher. Shane, you and I were talking about this earlier, thinking about what's out there. So we said, okay, we have earnings, but we always have earnings, and it's not like earnings have been bad. You would think if history repeats itself. We have the China tariffs. So Trump threatened 100%. We talked about that last week. That's old news at this point, and either will or won't happen. He's since come out and said, maybe we're going to find a common ground on here. We have the community banks, and we'll get into that a little bit later, but the community banks. But I don't know. I mean, Shane, November 5th is something I don't think has been talked about on CNBC, where the Supreme Court is going to hear the case of whether the tariffs that Trump enacted under, I forget what it was, IEEPA, whether or not they are lawful or not. And if they're deemed not to be, I don't know if the market's going to like that. Some people say, yeah, it's going to rocket on that news. Other people say, well, to unwind these, what does that mean? They got to rebate companies, or wait, we can't put tariffs, but every other country can. Shane, is it the November 5th? Is that not being talked about enough?
I don't think so. And I also think that it's foolish of anybody to say that they actually know whether a ruling in one direction or another will cause a specific outcome. Nobody knows. I'll tell you a week later, what the right call was.
You'll come back and let us know? Okay,
exactly. Great. Absolutely. With that being said, though, it's an uncertainty and it's an unknown. When I think of uncertainty and unknowns, I think of hedging pressure, put buying flows, people maybe pulling money off. You see things that are more flight to quality products might catch a bid, things like gold, bonds, etc. And so I just think it's one of those situations where the closer and closer we get, it's kind of the old, like, hey, don't look at it. It's, if you don't look at it, it's not there. Well, eventually November 5th is going to be here. And the closer we get to it, I think the realer it gets, and the more of an effect it could have on investor psychology and overall just flow behavior to the market.
Well, I mean, we also, Mike, we forgot to mention the government shutdown, which I think at this point is a non-issue. Market doesn't really seem to care about that. But we do have on the 29th this little meeting. Chairman Powell and his friends get together and talk about rates. Like, Mike, if they do anything but lower a quarter point, I think the market's not going to be happy with that.
Yeah, I would agree. That's the expectation. Anything else? I mean, unless they lower it more, staying where we are or doing anything other than that, I think would be a shock to the market. Market's sort of at the same time pricing it in. So I don't know really how the market reacts to that. Whether there's a run up, I'm not sure that the market is going to run up based on that news.
So there's 100% probability based upon, I'm looking on Bloomberg, the world interest rate probability screen, the Fed funds futures. Yeah, 100% probability at this point priced into the Fed funds futures, not certainty, but it's what the futures are trading at. And there's 100% probability of a quarter point cut, an additional one in December. And then you get to March. So they're pricing in 3 cuts through March, 4 cuts through June of next year. This obviously changes. But yeah, I mean, it seems like Powell is okay. But, Shane, one of the things that's not talked about, and some people say obsess over this, but I'm very interested in it. They've been doing quantitative tightening at the same time they're easing. And the reason why they're doing it is they're letting the balance sheet run off, meaning instead of when a bond matures, they go and they replace that bond, but keep the size of the balance sheet the same. They're letting it run off. Shane, I think if they talk about stopping the runoff, so that means buying bonds again, or if they went in, Shane, and said, we're going to start buying mortgage-backed securities. I mean, if it was the Treasury, I think they'd be doing this already to try and bring mortgage rates down. But that to me would be, I feel like the market would rip, right? I mean, who knows, right? But that seems like that's what would be a logical outcome.
So it's interesting you mentioned that. I think a couple of days ago, Goldman Sachs said that they see the end to the balance sheet runoff coming, like moving up sooner. I think they said to February or January. I forget off the top of my head. But the point is that, look, you've got some of the bigger banks and players on the street sort of moving up their expected time to see the Fed's runoff of the balance sheet stop. And I believe you are correct. I don't think they're just going to stop running off the balance sheet and not start buying. And I've been making the argument to, friends I've talked to, like, we'll see what happens with bonds. I have some friends that are insistent that no one's going to buy bonds. He said, well, if the Fed starts QE again, I'm sure they'd be happy to. And so it very well could provide some fuel, again, to bringing stability and certainty to that area of the market. And when the debt market is stable, I think it usually flows into the equity market being fairly stable. So the sort of devil's advocate, if you will, here, my question with that is, why the sudden desire to move the runoff up, in time, make it sooner than necessarily.
You mean end it sooner?
Yes, to end it. Yes, to end it sooner. And I think that the situation going on in regional banks, it could very well be a blip and something to overlook here. But at the same time, I'm concerned a little bit with what's going on there and the sort of timing of all this.
I mean, I think the reason why they're looking at ending the runoff is that you're both tightening and loosening at the same time. And they could have just stopped the runoff and that would have been a loosening. So, I mean, that's part of it. I think Powell, he's not necessarily trying to keep his job because I think he would have done things differently. If that was his main goal, he would have done things differently. Maybe he's just doing this so when the new person comes in and they do more easing, he can say, "Oh, we already started that. Like, what are you doing differently?" I don't know, Mike. On the regional banks, though, we saw this play out. What was it, 2 years ago? I think when interest rates went up and they had some long dated maturities on, and the Fed came in and did a program to backstop them. To me, Mike, like this, because the Fed backstopped before, does that not mean they'll do it again? Like these regional banks are not as big of a component of the market. I mean, the big banks like the JP Morgans, the Bank of Americas, they have way more share than community banks. But it sounds like they made some loans that didn't work out right. Is this a big deal or move along?
I think it's a big deal potentially for the sector. What I'm hearing is that it's isolated. Jamie Dimon disagrees and thinks there will be more that do pop up. But you did see the regional banks ETF sell off over the past few days, so certainly affecting that sector. But overall, I don't think the market's too concerned about it.
It doesn't seem that way. I always go back to, as a technician, and this is a Ralph Akinpora thing. He always said, "Does price make news, or does news make price?" And it's really price makes news. If price does something, then you need to explain why. And if the market was unchanged, or was up a little bit, and the regional bank stuff came out, I don't think it would be as big of a news item that it was. Shane, you had done a little bit of research on the regional banks. Anything there that we didn't cover that you think is worth mentioning, or you want to talk about how retail is trading like crazy?
I want to talk about both. We'll wait for retail. I want to mention one more thing about the regional banks.
Yeah.
And they're proposing to ease essentially capital requirements. I'm probably way early on this. I don't look at banks easing capital requirements as necessarily being done because those banks are in a fantastic position or situation. I look at it as something that's being done to maybe accommodate risk there. And at the same time, let's be realistic. If capital flow requirements are being eased, like it's inevitably going to lead to more money being taken out. And that's probably a little inflationary and probably good for assets depending on what that money's being taken out on. My concern is that, does it become a bigger deal than it is? We see sometimes the market behaves a little irrationally, right? And these sell-offs or these crazy down moves can happen quickly. It doesn't mean it's the end of the world. Typically, markets recover shortly after, within a few months to years at max. But I don't know. It's interesting that 2 years ago, everybody freaked out over regional banks. And here we are 2 years later, and a little bit of concern seems to be creeping back up again. So it's just something to pay attention to.
And did I see this in our trading messaging that MTV is going away? Is that breaking news? That's probably what you wanted to talk about.
I mean, I had to mention it. It's MTV that changed pop culture, as we know it. I think you were around for the start of it. Mike was around for the peak of it, and I got the tail end of it. But I mean, it's pretty influential channel in television for quite a while there.
Well, I just did a quick search, and this is a very limited internet search. And I said, what year did MTV stop playing videos? Because my comment was going to be, it kind of ended a long time ago. And it said they stopped playing videos regularly throughout the 1990s and 2000s, transitioning to reality shows. So, yeah, early 2000s replaced by, when it started, and I remember they started, and not everybody had videos. So we'd get like the same 12 videos over and over again. And if you were homesick from school, you watched MTV. I mean, I'm talking, this is probably like, I don't know, 80, 81, 82. I don't even remember what year it was. Probably might have been earlier. And The Clash had a video. There was like, I remember them now. Rock the Casbah. That was on like every fourth video, I felt like. But yeah. And I remember we were doing an event. It was in Ohio, and the Rock and Roll Hall of Fame is in Ohio. And if you're familiar with the group Joan Jett and the Blackhearts, their guitarist, if you were staying at the hotel, you were allowed in the hotel, and a lot of the artists were there, and there were some politicians and stuff. But I remember talking to the guitarist, and they filmed that I Love Rock and Roll in just some bar on like the Upper East Side, I think, in Manhattan. And he said MTV back then was like trying to get artists to do videos. So, all right, a little tangent, but I would say if you were long MTV stock, you've lost a lot of value in a long time ago. Like that was a dead cat bounce that never happened. So All right, Mike, you probably were in the '80s when they were doing like the Total Request Live and stuff.
Yeah, like I would say mid late '90s. Total Request Live. That was like come home from school and watch that every day to see who was going to be the
Oh,
number one video.
yeah, I was probably a little older than I was probably past my peak MTV watching time. But all right, anyway, back to this. Let's talk about retail trading. Um, Shane, you had some data on this, and you said, I think your comment was retail's trading like crazy again, right?
Yeah, just buying calls like madmen. It's insane. If you look at this, sources from Citadel Securities as of October 15th, 2025, lovely bar chart here provided by them. Looking at retail options flow, call put direction ratio trading by week, January through October this year. This week, or I should say, it looks like last week. I can't tell if that's last week or this week, but very recently we've seen the largest ratio of call to put buying in all year. So, um, you still have retail stepping up, and it looks like we've only been 4 weeks out of this entire year put buying overtook call buying at the retail level. One was early January, one was early March, and then the other two times, ironically, were in April. So I think that also maybe gives some light to, hey, when retail steps up and buys a lot of calls or buys a lot of puts, it can have a pretty significant effect, especially if it's shorter dated options with the hedging flows.
Yeah, I mean, Mike, we definitely see that in market mechanics where if retail is buying calls and you're buying a call, if you're the market maker, Mike, you've got to take the delta and buy shares. So I buy a call from you. If it's 20 delta, you've got to buy 20 shares. But if the delta increases, you've got to buy more shares. So it affects market dynamics. But Mike, I would say I think retail has gotten this rally right. I think retail was first to step in mid-April, and it's the institutions that have lagged. I mean, I could be wrong on that, but that's how I read the room.
Yeah, it seems like retail has gotten some guts during some volatile times, and just looking for opportunities to get long. Now, I mean, I would argue that this it looks like it's October 6th where this hits a peak here. October 6th is very near the all-time high. So is this a leading indicator, or is this something the market's hitting all-time highs and now more calls are being bought than ever by retail investor? I don't know. Um, that's sort of how I see it, though. This may be more lagging than leading.
I mean, a lot of times, Mike, people say the retail client is the dumb money and the institution is the smart money. In this case, all right, it's a fair point. Are they piling on at highs? Do they have FOMO, their fear of missing out? I don't know. Like Shane, you're younger than both of us, and you probably haven't been through a time where buy the dip hasn't worked, right? I mean, I think throughout your career, professional career, buy the dip has worked. So I don't know. I
20,
mean, buy the high has worked too.
yeah,
Typically, even buying highs, markets go higher.
absolutely. 2022, the year that SPACs got wrecked, the market had a rough year. Yeah, a lot of the guys I knew that were hot shots from COVID on, that were crushing it because they just punch buy calls or buy shares and just keep buying, keep holding, keep rolling. 2022 was a really rough year for a lot of people. And at the same time, there is a level of resilience, I think, in my generation, um, in trading short dated swing trading options and equity and futures. And it is that, I think a lot of people believe that there is, if you do it right, you can make money. I mean, isn't that the whole point of participating in markets? We're trying to make money here. Um, and with the inception of shorter dated options, like it's sort of like I think my generation can get punched in the face and keep coming back. Like they don't care. Um, I also want to point out that it doesn't this chart doesn't necessarily mean retail is making money when they buy these directional calls.
That's good. It's a fair point. Yeah.
Right. It's some are, I'm sure. There are plenty. Otherwise, it wouldn't be happening. But at the same time, um, who's making money, when they're making money, that's gonna vary. And so, but one thing's for certain with this generation specifically, um, they want to be in the market. They're typically bullish. They typically, I think, see the market as their way to establishing financial freedom or a level of, um, just financial well-being that otherwise they can't get anywhere else. And so, of course, you see everybody willing to step up and take shots.
I mean, take shots is one thing. I mean, I guess I go back and forth on this because I think, yeah, there's a buy the dip, but that also implies that one was in the markets, knew the dip was coming, got out, went to cash, and then knew exactly when to get back in. I mean, you could make the argument there's repositioning. So if you had a portfolio, maybe you get a little heavier into equities. But I don't know. I mean, Mike, you kind of, do you remember the 2000, 2001, 2002?
I mean,
I've asked you this before because I'm always, when you get old, I remember all these periods. So
somewhat. I mean, I was like 13, but
all right. Well,
I remember.
like,
Yeah, I remember my dad trading in it.
that's like when people ask me about 87, I was in high school,
Right.
but I certainly remember it. I mean, like 2000, 2001, 2002, that's when people had apathy. Like there was panic, and then there was just apathy. Like people got the brokerage statements, they put it in a drawer, they didn't read it. So I don't know. I mean, Shane, when you look at this chart, and it's a little tough to read with the scale. I don't know if they're saying that the previous high on retail option buying was actually right before the tariff tantrum, because this only goes back to January of 24, right? I don't know total options volume. Yeah, so that's interesting. Like you look at total options volume, it seems like right before the tariff blow up, total volume was up. It was not as high as it is right now, but retail was not as high. Like retail was more of an equal high to February, and they didn't come back in until
Yes.
after April. Like they actually, that's what I'm talking about. Like the dumb money was the institutions.
Well, and this is where, so
I mean, I don't know what they're buying. This is just, they could have been buying puts at the bottom, and that didn't work out.
Right. I mean, the thing is I agree with your statement earlier in that the majority of retail misses. The retail typically performs the best, the majority of them, I believe, in an upwards bullish market. That's where they make money because it's the easiest thing to do. Just buy or buy calls or, something that's long deltas and just ride it out. At the same time, yeah, I think that retail flow, when it's not that it's coordinated, right? Like Wall Street Bets was a really interesting situation and thing to observe. It's almost like a phenomena, like, wow, this is actually possible if enough money, and we've known that forever, if enough money coordinated in one direction is done, like the market's going to move higher. That's
But
going to
you need a lot of retail
you
to
need a
make.
ton of retail, right? And
You
so
need a
that
ton of retail to equal one institution.
absolutely. And so if there's a general everybody is on one side in retail, I think sometimes retail does really well, right? And all of retail eats. But when they're all wrong really, really badly. And I think that's where you see institutions sometimes are on the other side, like, hey, we'll sell you this and you can hit 90 out of 100 times, but when you finally miss, one of those 10 times every 100 times in that distribution, you're going to miss so badly that you're going to give this back and some. So it's a very interesting area of the market. And I'll say this, I got to know, because you were there for it and I wasn't. Has retail trading evolved or changed significantly, in your opinion, from what you saw in the 90s and 2000s to what you see now?
The tools are way better. There's more access to information. I think herding, traders herding to, there being a herding mentality has not changed. And I think the speculatory nature has not necessarily changed. It's just gotten different. I mean, this goes back to, was it 90, 93, 94, where the big thing was obviously emerging markets back then. I shouldn't say obviously, because not all the audience remembers, but definitely emerging markets. But then it was like people were buying anything like Telefonos to Mexico, Telefonos to Chile. That was like the precursor to the .com. It was the Telefonos whatever. And that was going to be a big thing. Like everybody's buying the telephone stocks. Like wait till you get the infrastructure built out, you get all this stuff. And people piled in. They bought at the highs. So no, I don't. It's never different, but it always changes the color that it is. And I think that's the way to put it. No, I mean, we saw this. I mean, look, Shane, I saw people buy IPOs on day one. And for a while that worked. You bought an IPO that was up 300% and it wound up closing the day up 400%. And it worked until it didn't work. So it's the same, but it's different. And something else will come along. The Wall Street bet stuff, though, and GameStop, and for what's the other one? The theater. What's the theater?
AMC.
AMC, yeah. Like that's kind of interesting. I mean, that's definitely different. They wound up with a movie made on it. I don't think a lot of people made money though in the long run. They were probably buying options that had a ton of juice. So, and that's my quick thinking on it. And what has worked, what's really undefeated, is you invest over time as you're getting your paycheck, or you periodically put money in accounts, and you're long the market over the long term. And as your situation changes, I mean, we would say we buy and hedge because a lot of our clients are closer to retirement. They're not in the get rich era. They're in the stay rich. But that's undefeated. It really is over the long run. So we'll see. All right, Mike, let's change gears. Any earnings coming up? It's a big next couple of weeks. What's like the one that you're sort of like, I can't wait for them to report? And you can't say NVIDIA because they're not in the next couple of weeks.
Dang. I love some NVIDIA earnings, but we'll have to go to Tesla then.
Okay.
Tesla's also a good one. They have earnings coming up next week. It is on the 22nd. They'll report after the market closes. So,
what's the option market saying as far as you can tell? I know we were looking at that earlier. We pulled one of the Bloomberg screens there. What's sort of the vol there? What's it saying for an expected move right now?
Yeah, so the stock is closed at 439.31 today. So you got the 440 strike calls and puts trading at about $17.50. So looking at, just doing some math, like a
$35.
$35. Right? Thank you. I was dividing that by the stock price to get a percentage, about 7.5% if you buy the at the money calls and puts. So that's sort of the implied range at this point, about, what is it, 4 days before earnings.
Yeah, and I mean the implied volatility, what is that? A little over 70. Little over 70, the implied volatility. On a 1 day basis, you kind of take that divided by 15.875. I know these don't go off until Wednesday, which is 3 trading days from now. But 70 divided by 15.875, it's implying about a 4.41 standard deviation sort of move over one day, and then you take the square root of 3 times that, and it tells you what the implied move is between now and the end of the day. But I don't know. I mean, first of all, if you buy the straddle, which is buying the call, buying the put, often people think, oh, that's an easy trade. I know it's going to move. But you just said, I mean, it basically has to move 34 points. So it has to go to what? 475 about?
To break even.
To break even, just to break even. Or it has to go like to 405.
Right.
So outside of those, you lose money, right?
That's right. You needed to hit one of those levels and then go higher or lower. Those are your break-even points. So any move smaller than that, you're losing money.
I feel like Tesla, I am looking forward to their earnings because I want to hear what Elon says. The stock has definitely recovered. And they'll probably talk about robotics, automation, AI. So they'll work all that stuff in. Shane, we've talked about this before where you say, well, as options get priced up, you say, well, buying the straddle is a difficult trade because you need to be right on direction. But because volatility is so high, like the bar is much higher just to get to break even. And then Shane, you reverse it. You say, well, I'll sell the straddle. Of course, then you have unlimited loss to the upside. So not a great idea. Maybe you sell a spread, but that's no picnic either because market's not always right with calling what the implied move will be versus the actual, right?
I think it's all involved in itself, if that makes any sense. Right?
Not really, but tell me.
Okay. So it's it's really my personal belief on a positions move, whether it's earnings, whether it's unforeseen news announcement, whatever it may be, whether it's day to day, it's the fulfillment of everybody making decisions, right? And so however we go into this positioned in options, I think that is going to have a huge effect on sort of guardrails and where the book has to maybe hedge those short dated options for next Friday with all that vol in them. Now, realistically, I've never believed that you can just know what a stock is going to do going into earnings. If you do know how to do that, please call me. I would love to talk to you. But again, I think that when you sort of do what you and Mike were just doing, but maybe map out where's the open interest, where's the majority of the volume going on leading up to the earnings announcement that day, you can kind of get a picture for maybe where your guardrails or boundary are. And it's ironic because what you'll end up seeing is that the range they're typically pricing in, it's usually the range where there's a bunch of open interest to the upside and a bunch of open interest to the downside, right? That usually corresponds. And I don't think that that's a coincidence, if you will. But realistically, we find ourselves in an interesting situation. Vol was getting elevated this week for reasons outside of just earnings coming up, I think. More fundamental or maybe geopolitical, or like Mike said, maybe it's just concentrated into the banking sector, and that's why VIX got crushed today.
All right, let's look at another one, and I'll ask you, Shane, give me a quick answer. Just throw me a number, and Mike, you do the same. Intel reports, don't look it up. Intel reports next week. What do you think their implied volatility is? It's not a trick question.
Because of the government's involvement and stake in it, I would think that Intel's pricing in a 9-point move.
Okay. Mike, what do you think?
I'm going to go with...
You can give me the IV number itself, or you can tell me the implied and make me do the math. But either way,
IV, I would say 40.
If I have to guess IV percent, I'm gonna go ahead and guess 120.
Okay, you're both wrong, and I wouldn't have gotten this. But when's the last time Intel had a higher implied volatility than Tesla? when they reported in the same week. The implied volatility on the 30, I'm looking at the 37s, which is the at the money, 105.
Wow.
Is that right?
It's plus 100. Yeah.
Which is a 6.29 implied 1 day move. And then you kind of, their Thursday square root of 4 times that. But yeah, I mean, it's a little different. I mean, Intel normally, especially in the old days, they would have the volatility more like Apple, if that much. That's high for them. I can't think of when they've been higher than Tesla. So I think that'll be interesting. Netflix is also next week. And Netflix, and by the way, for anyone listening who says, why are they talking about the implied volatility in earnings? The formula here is you take the square root of time, which is 252, which is 15.875 and a bunch of numbers. If you take the implied volatility, that's the implied move, and it's annualized, and you take that divided by the 15.875, and that gives you an estimated one standard deviation estimate range of expected movement for 1 day. And then if you're doing it for 4 days, based upon that, you take the square root of 4 times that, and it tells you the expected one standard deviation move over 4 days. And then for 2 standard deviations, just double it. Netflix, by the way, is less than both of them. So Netflix, let me just make sure, they close right around 1200, just a little bit south of there. Yep. So Netflix. Oh no, Netflix is more. 164 implied volatility. I'm not sure that's. Oh no, those are today. Don't look at today's. Today's market's closed. Rookie mistake there. Me not changing the expiration. Netflix. Okay, 71. So them and Tesla are basically the same. Intel's higher. So what that means is the options market is estimating a greater expected move on Intel around earnings than they are Tesla and Intel. And we'll know next week whether the market's right or wrong. So, okay. Any other earnings, Shane, that you're kind of looking forward to? By the way, TSMC, they always report early. They're often not talked about as much, and they report in the morning. I think they had 40% year over year revenue growth. I think their net profit margins are still right around 40%. Like a pretty good report from TSMC.
Yeah, that's going to be a really interesting one to watch. I think that, look, it's something that I find it kind of ironic. There's a lot of talk about Taiwan semiconductors being, what's going to happen with Taiwan, right? And I think the market sort of shrugged that off. But that'll be a good one to watch. I think the other one that I know it's not as big as it used to be, but IBM, right? I think that actually came up on your list of was one of the biggest or the biggest company in the market at one point, right? But I'm interested to hear what IBM's got going on because they are big in artificial intelligence. And so I wonder if they're a sleeper or they come out with some news that wasn't expected and end up being a hard beat and maybe reaffirm the AI run is nowhere near to be done. We'll see.
Mike, I know the one you're on pins and needles. Well, I don't even know if I'm using that expression right, but I know the one you're really waiting for, can't wait for, cannot stand another day to go by without the earnings of Open Door on November 6th. I know that's your biggest one, right, Mike?
That is, I've been waiting months for this one again. It's just my favorite.
You and the Wall Street Bets people, right?
Yes, we're tight.
I really don't even know. Do they even have positive earnings? I have no idea.
I don't think so.
Yeah, they're basically trying to be a market maker.
-4 cents on their last report. In their last report, they were trading at about $1.75 to $2 a share that week. They topped at $10 a couple weeks ago and are now $7.16.
I have no opinion on the stock, but Mike, you mentioned you spent time on the floor. They're trying to be a market maker. They're trying to solve the problem of when you have to move and you have a house and you've got to list it for sale and you don't know when you're going to be able to sell it. So they're trying to say, yeah, we'll buy somebody's house and then we'll sell it and we'll make a profit there. Mike, that's kind of what traders do on the floor. We don't have to spend any time on this. I was actually just,
It's
just
interesting.
trying
It's
to
an
make
interesting idea to like provide liquidity, because you know that,
right
when you're
liquidity.
selling a house, you're probably buying another house. And, I would say the vast majority of people want to sell their house before they buy the new house, or at least do it somewhat simultaneously. So it's an interesting idea to provide that liquidity. I think the actual operation of it, and here we go, getting into open door, but the actual operation of it has got to be difficult. You're buying a physical asset. This isn't, a stock that you can buy and then flip in seconds if you need to.
I don't know if they do. Actually, I do know a little bit about this. Somebody told me I think they might do a walkthrough, and then if there's things that are really wrong, they'll adjust the price. But essentially, I think they make an offer first, and then they do the walkthrough or they do the inspection. I would imagine. But no, you're right. Like, it does solve a problem. I've been in this situation where I remember writing an offer on a new house contingent on selling my old one, and they're like, "Yeah, great, but when are you going to sell it?" So it would solve a problem. I don't know. Um, yeah, I don't know. The other one, Mike, I would say, got Cisco reports on November 12th. That I remember when that used to be the big stock, but Meta, Alphabet, Microsoft, and Apple over next 29th and 30th. Like, that's obviously a big day. And then, of course, NVIDIA. NVIDIA is, and everyone says it's the most important earnings report ever, and they'll say that again this time. But I know you were half joking about that, but yeah, NVIDIA is the one for me too. Like, to wait for.
Yeah,
So we'll
it's
see.
one of those where if they don't meet expectations given the run up, or even if they meet expectations, you could see profit taking. There's nothing exciting mentioned on the call, so that's going to be a big one for a while, I have a feeling.
All
I
right.
I feel very strongly about some of the NVIDIA deals going on right now, and I know we're not going to dive down that rabbit hole, but I don't know. What? Let me ask you this, Derek, real fast. I'm
I
sorry.
signed my own NVIDIA deal. I was going to tell you guys they're building a data center in my backyard next to the pool, and it's going to be fantastic. No, I haven't. I mean, that is one of the knocks, that these companies are all making deals with one another. Like, the capex is going out of the left pocket, going into the right pocket. We'll see. We'll see what happens with all this. But
I mean, you played Cisco. You were there for the Cisco, right?
mm-hmm.
I mean, it's I believe in AI. I believe that this is all going to happen. I believe these data centers are going to be built. I believe they're going to adjust the energy infrastructure of the United States to do so. And at the same time, you know, I don't know when we get there and start to see the real return. I think
But Cisco never got cheaper, though. That's the difference.
yeah, that's a good point.
Yeah, I mean, they're forward PE, their PE, their backwards PE, their actual versus their forward. They were always expensive. Like, Nvidia has made new highs, but their forward PE is lower than it was previously because the earnings expectations have gone up. I think that's the big difference. And
Absolutely.
I have no idea. If you want to buy NVIDIA, buy NVIDIA. If you want to short NVIDIA. Just be careful because you have unlimited loss. Like, don't do that at home. That's why we buy the index and we hedge, which brings me to my next point. And Fortune 500 data stream, Goldman Sachs, investment research, apparently took 3 people to put this chart together. So it must be good. Largest companies tend to belong to dominant sector of the time. And this is since 1955. It's percent market cap or percent net income before 1974. Okay. But it's basically a chart showing who the biggest company was and the percentage of the overall market. And one of the things you find is that General Motors was the biggest company from, it looks like 55 to early 1970s. ExxonMobil had maybe a year or two in there, and then General Motors took over again. And their share of the market as a single stock was higher than Nvidia's. Now, again, they're using net income prior to 1974, so maybe it's not a great comparison, but it's their chart, not mine. You go to 73 or 74, IBM. So remember, Exxon had that 1 year. IBM has a run with AT&T. It looks like maybe 1981 was the largest company. Exxon, IBM went back and forth. GE is the largest company in, I'd say, 93. By 98, Microsoft makes an audition in there. GE flips back to Microsoft, back and forth. And then Exxon. Exxon is from 06 to 12. They're the biggest company. And then you have Apple. I think in 2018 it was Microsoft, but really it's a lot of Apple, and then more recently Nvidia. And I think there's really 2 points to this. Number one is, yeah, I mean, Nvidia right now is a share of the S&P 500 as a market cap. I mean, it's higher than GE ever was, at higher than Exxon was, higher than Apple ever was. But you go back to the pre-1970s, and according to this chart, General Motors is pretty high. The other thing I would say, it's a good reminder too of how this is a living, breathing index. The companies come and go, new entrants come, companies leave, things happen, and the leadership changes. I mean, imagine you had said way back when, oh, I'm going to buy General Motors and I'll just put all my money in General Motors because that's going to be the best one because they're the biggest stock. Of course not. And Nvidia is the biggest today, but somebody else will be the biggest at some point, if history is any guide. So I don't know. I mean, I know the audience can't see this chart, but Mike, I feel like this is just another reminder of why we index, why we certainly buy indexes, and we like to hedge them. Anything surprising on here? Like, were you surprised to see that Exxon was, even as late as 2012 or 2011, was still the biggest company?
I follow sort of the heaviest market weighted companies fairly closely, so I was aware that Exxon was up there for a few years there. But yeah, I mean, it's not only you see companies flipping in terms of the biggest companies, but it's even the sectors are changing in terms of what
Right.
sector is dominating. So to say we buy an index, not only are you capturing all the companies, but obviously all the sectors too. It's hard to even pick what sector is going to be the best sector for the next 10, 20 years. It certainly looks like tech and even more specifically semiconductors right now, but in 20 years, who knows what that company is going to be and even what that sector is going to be.
Well, it could be the same sector, Mike, but a different company.
Sure.
I mean, IBM, you could argue, was technology, and that was 74 through, I don't know, 89, with 1 year where AT&T was supplanted it. But right, I mean, that was technology back in the day.
It was technology back in the day. I guess what I'm sort of getting at is you see Exxon coming in there. If you just own tech, you're missing out on energy when energy is doing better than any other sector. Same with GE at times, General Motors. So I think it's just it's not only the stock but the sector as well. So,
and right now, oil is not loved. This is why you own the index. So you still own Exxon, you still own Chevron in the index, and if those companies, if that sector makes a return, you'll participate in that. It's the benefit. Shane, we've talked before about, I don't think people realize, or they understand. That's not a word, but I just made it one. Or they underappreciate companies leaving the index and new companies coming in. We talked about Robinhood is now in the S&P 500. We talked about Interactive Brokers, Open Door, not Open Door, not Airbnb. Airbnb was never in the index, and they came in last year. Like, this thing is always changing, but it's a momentum index because you own more of the companies that are growing and you own less of the ones that aren't growing. And companies that are growing that aren't in the index tend to find their way into the index if they're S&P, American companies. So I don't know. Any thoughts on this, Shane?
I know. I think that, over time, it just, it's really hard to beat the market, and it's really hard to time tops and bottoms. The market is a living, breathing thing that evolves. If there's parts of it that are decaying, if they get bad enough, eventually we just cut them off, and there's going to be something somewhere else that can make up for it. And so that's perfect example of, again, it's a living, breathing thing. It's really hard to time it. It's really hard to pick individual winners. And so by broadening out what you're holding, not necessarily panicking and selling Exxon right now because oil's not doing
I
great.
think we lost Shane there. Mike, did we lose Shane?
We lost
Can
him.
you hear me?
Oh, he's coming back. I'm sure. And you were just about to say the most insightful thing you've ever said. So,
Oh, sorry. Just long story short, look, you got to own everything and hold through it all and buy and hedge, right? That's the name of the game, buy and hedge.
name of the game. Okay. Let's go to our recommendations. So, Shane, I'll start with you. I told you to watch Mayor of Easttown. It's Mare, I think is the spelling, with Kate Winslet. Have you watched that? What's your impressions? Would you recommend it?
My fiance and I are about halfway through. We would highly recommend it. It's been some of the best TV we've watched in a long time. I was told by another one of our employees, if I like that, check out The Task, which is by the same person who made Mayor of Easttown, I believe. So I think The Task is next up on our list. Beyond that, the Steelers.
Well, you got to watch Black Rabbit. You got to watch that one too.
Oh yeah.
That's newer. Yeah,
definitely.
Is it Mayor of Easttown? It's not Mayor. It's Mayor. Mayor is her name.
Yep.
Mare. Yep.
Yeah, that to me was some of the best TV. I agree. And it was a limited series, so it's only one season. They've talked about maybe doing another one, and I think she would be interested if it was a good idea. But
that's what I mean. She won't commit.
I'll have to talk to you once you finish it, so I can. There's certain episodes you're going to be like, oh my god, that was awesome. So okay, yeah, Black Rabbit though, and Mike, that was you and I. We talked about Black Rabbit. We
just finished it.
Anything new now that your baseball season is dead and gone?
I would put it on the strong buy. I think I was about halfway through it.
Mike, did we lose you there?
Spoke. Finished it over the weekend, and it's phenomenal.
All right, I didn't hear you for a second, but maybe it got picked up on the recording. What did you recommend? Just to make sure we get the listeners.
I was just reaffirming your Black Rabbit recommendation. I did finish it finally. Strong buy. And then, I feel like every time I'm on here, I have some different sport I'm talking about. Hockey's back. So watching as much hockey as I can.
Yeah. And you're a Blackhawks fan, I imagine.
I am.
With Bedard, and they seem a little better this year. So
mediocre would be great. That's all I want. Let's just be average.
Mediocre.
Let's just be average this year.
You want to just miss the playoffs, but win the draft lottery.
I'd love that.
That would be great. Yeah, I mean, look, I'm a big hockey fan. We have Canadian listeners, great listeners that we have, and I think they appreciate during the Stanley Cup Finals and Stanley Cup playoffs. I actually do talk a little bit of hockey here. So, and the producer for the show who takes our audio and packages it together. We never edit it, but we make sure the sound is. He is a big hockey fan. So, all right. Anything else? I think. Oh, I didn't give a recommendation. I watched that Unknown Number documentary on Netflix, and I really can't say anything about it because I'll ruin it. I'll ruin sort of the ending of where it goes, but I don't know. It was 40 minutes that I took to watch it. It was okay. I don't know that I'd watch it again. It's not a buy. It's not a sell recommendation. It's not a buy. It's kind of a hold. So I don't know if you guys have seen that. Have you?
I saw it. I don't think there's a need to watch that twice.
Certainly not twice. Debatable whether we should even have watched it once, but I'll let the audience decide that. Shane, Mike, Thanks for coming on again. Big week of earnings. And we have that Fed meeting on the 29th. So that's coming up. Not next week, but the week after. And November 5th, I think you're going to start to hear about the Supreme Court case. I don't know what the market wants. The market didn't like the tariffs initially. Now they're okay with them. If you reverse, is the market mad about what it previously would have been happy with? I don't know. We'll figure it all out next week. All right, guys. Thanks for coming on. And for everyone else, we'll see you next week. Take care.